Hello and welcome to another session of the My Solo 401k Financial, My Community Daily Webinar Series. Today we're here to discuss Solo 401k hack for high earner, not rich yet individuals, otherwise known as Henrys, specifically the Mega Backdoor Roth, and how it's a game changer for those high earner, not rich yet individuals. If you have questions or topics that you wish to discuss, please chat those over, as we're happy to go through those questions or topics. And we'll start out with the one that was already chatted up. But if there's others that you have or questions on this topic or even unrelated topics, don't hesitate to chat it up. The presentation, of course, is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. So before we dive in, let's start out with the first question. So I'm in the process of setting up my 3 brokerage accounts for my solo 401k, traditional, Roth, and voluntary after tax. My payroll processor, Gusto, it looks like they will support pre-tax and Roth and report in the W-2, but does not support after tax. And can you walk through the mechanics of how to properly move money from the company into each of the appropriate brokerage accounts? So first of all, thank you so much. I mean, one of the top reasons that people sign up with us is the ability to make Mega Backdoor Roth contributions. And the way that is done is by making contributions to different accounts. So individuals will end up having one plan with us, but multiple sub accounts, as you do with a pre-tax, a Roth, and an after tax. Now, I gather that your business is taxed as an S corporation because you're working with the payroll provider, Augusta specifically. So one's ability to make contributions is going to be based on the W-2 wages that they receive from the S corporation. So when you make those employee contributions, either pre-tax or Roth, those do need to be reported on the W-2. So typically what happens is customers will have to let Gusto know at the end of the year how much they made in either pre-tax and or Roth employee contributions so they can be reported on the W-2. The voluntary after-tax contributions, though, do not need to be reported. They don't need to be reported on a personal tax return, a business tax return, or the W-2. So if you look at the W-2 instructions, they're clear that voluntary after-tax contributions do not need to be reported on the W-2. It's optional. Now, when you make that Mega Backdoor Roth contribution, what you're really doing is it's a 2-step process. So you are first depositing the after-tax money into the after-tax account, and then it's being transferred from the after-tax account to the Roth account, step 2. And here's a procedure page that goes over how it works in more detail. As I mentioned, the first step, the contribution, that doesn't need to be reported on the personal tax return, the business tax return, or the W-2. But the second step, when you move the money from the after-tax account to the Roth account, that does need to be reported on a Form 1099-R. And if you look at that procedure page, that's the last step in the process. And there's a link to a page on our website that customers use to let us know about the money that was transferred from the after-tax Solo 401k sub-account to the Roth Solo 401k sub-account, so we can capture the information that's needed to prepare the 1099-R. Hopefully that helps. Thank you so much for bringing the good question. We definitely appreciate it. So if there's more questions or follow-up questions on this topic or other topics, don't hesitate to chat it over. So now let's turn to the slides that we wanted to share. So let's first lay the foundation with who is a Henry. Remember, Henry stands for high earner, not rich yet. Well, so that's going to mean the person's a high earner. So think like $250,000, $500,000 or more per year. In our experience, a lot of times these are individuals that are working in the medicine field or the legal field or the tech field, right? They might be a AI consultant that's getting paid relatively high amount of money as a self-employed individual. So they have a high income, But that necessarily also means a lot of times that they have high taxes, they may have debt, right? If they went to medical school, they may be living in uh, an area where the living expenses are high, right? They might be living in a big city with high living expenses. And their traditional retirement options may fall short, right? If you're making $500,000 a year, being able to contribute $7,000 to an IRA is nice, but it's not really moving the needle for you, just to give a simple example. So essentially, it creates a problem, the retirement savings gap for high earners. Again, if they want to make a Roth IRA contribution, they're not even eligible to make a Roth IRA contribution because they make too much money, right? Above a certain income amount, the rules will not allow you to make a Roth IRA contribution. Now, they may be able to make a backdoor Roth IRA contribution, but still they're only making $7,000 a year, which again is nice, but is not necessarily moving the needle when you're making $500,000 or more. That's where the solo 401k can step in and provide a more powerful solution. So for example, with the solo 401k, the contribution limits are 10 times the IRA contribution limit. Instead of 70,000 for 2025, the overall limit is 70,000 or even more if you're age 50 or older, right? So 10 times that backdoor Roth IRA contribution limit of 7,000. So it could be a solution, or at least a partial solution, to help close that retirement savings gap. Now, of course, you have to be eligible to set up a solo 401k, meaning you got to be self-employed with no non-owner, non-spouse, full-time W-2 employees working for any business owned by you or a spouse, if any. Now, if you are self-employed with no W-2 employees working for any business owned by you or a spouse, if any, you're eligible to set up a solo 401k. And a solo 401k has the highest contribution limits for any defined contribution plan available to self-employed individuals. And that's because, in the words of the IRS, you're both the employee and the employer. So you can make both types of contributions. And then, as we'll see, on top of that, you could even make additional after-tax contributions if you have a plan like the one offered by my solo 401k Financial that allows for after-tax contributions. And after-tax contributions are how one makes mega backdoor Roth contributions. So for example, the contribution limits for a solo 401k for 2025 are $23,500 as an employee limit, plus more if you're age 50 or older. If you're 50 or older, you can make another $7,500 in employee contributions, or $11,250 if you're 60 to 63, the so-called super catch-up contributions. On top of that, you can also make an employer contribution. Now, the employer contribution limit is going to be a percentage of your self-employment income. So if your self-employed business is taxed as a sole proprietorship, then your ability to contribute is based off of self-employment compensation, where you have to run a pre-calculation. And we help our customers run that pre-calculation. But that calculation consists of taking your net income. So for example, on line 31 of Schedule C of your 1040, so after your expenses associated with your self-employed business, reduced by 1/2 of the self-employment tax. Now, that is the figure upon which you determine how much you can contribute. So for example, with respect to employee contributions, you can contribute 100% dollar for dollar up to $23,500 or more if you're age 50 or older. Employer, it's 20% of that amount. Now, if your self-employed business is taxed as an S corporation, your ability to contribute to the plan is based off of the W-2 wages that you receive from the S corporation. And in that case, the employer contribution limit is 25% of those W-2 wages. Now, the overall limit is $70,000 for 2025 or more if you're age 50 or older. If you're age 50 or older, it goes up to $77,500 because of the catch-up, or $81,250 if you're age 60 to 63 because of the super catch-up contribution limit. So the Mega Backdoor Roth Solo 401k is a very popular option for those high earners in our experience. Maybe you're a high earner, not rich yet, so you're a Henry. So that entails making voluntary after-tax contributions. So you need to have a plan like our plan that allows for voluntary after-tax contributions, step one. Then step 2, converting those after-tax solo 401k funds to either a Roth solo 401k inside the plan, or transferring those voluntary after-tax solo 401k funds out of the plan to a Roth IRA. So you have to have a plan that allows for that conversion to the Roth account. And that's important because you want to get the money into the Roth account so that it can have the potential for tax-free growth. Because once it's in that Roth account, it's going to be like other dollars in your Roth Solo 401k, where it's going to grow tax deferred. And then when you withdraw the money, if you withdraw it as a qualified Roth distribution, you're going to be able to take it all out totally tax-free. Now, some of our clients will take a blended approach. They may first make pre-tax contributions to reduce their taxable income now for the year for which they're making the contribution. So maybe they'll first maximize the employee bucket, then maximize the employer bucket, and then whatever's left they make as a voluntary after-tax contribution. So then they're getting some diversification. So they're getting some tax benefit now by making that pre-tax contribution, but then they're also making Mega Backdoor Roth contributions to get some dollars into their Roth account. So they get some benefit now, some benefit potentially later. So let's assume, for example, they have $100,000 of W-2 wages from their self-employed business, taxed as an S corporation. Let's assume that they're under 50. Let's assume that they don't make contributions to another plan like a day job plan. So in that case, they'd be able to put in, for example, for 2025, $23,500 as a pre-tax employee, $25,000 as an employer, and then they make the difference up to $70,000 as a voluntary after-tax, and then transfer those funds either to a Roth IRA or keep it in the plan but transfer it to a Roth Solo 401k. So that's the blended approach. Whereas others, they really want to just focus on those Roth dollars. So they may skip the employee, skip the employer, and make 100% of their contributions as a voluntary after-tax. So taking that same example, instead of first filling up the employee, then making employer, that person may just make a pure 100% $70,000 voluntary after-tax contribution into the voluntary after-tax solo 401k account, and then transfer those dollars out of the account over to the Roth Solo 401k, or out of the plan over to a Roth IRA. So why the Mega Backdoor Roth Solo 401k may be perfect for Henry's? Well, massive tax-free growth potential, right? It's like we talked about, 10 times the contribution limit to a Mega Backdoor Roth Solo 401k as opposed to a Roth IRA. You also don't have to worry about the income limits. Remember, we talked about the Backdoor Roth is a workaround for Henry's because they make too much money, right? So above a certain income amount, you're not allowed to make a Roth IRA contribution. Well, there are no such income limits that apply to one's ability to make Mega Backdoor Roth Solo 401k contributions. Again, the max contribution potential, right? 10 times. Also avoid RMDs, right? RMDs do not apply to a Roth IRA. And now, thanks to Secure Act 2.0, they don't apply to Roth Solo 401ks either. So that's RMDs are when you get to a certain age, the government forces you to withdraw from the account. Well, it no longer applies now to Roth Solo 401ks. They've equalized it. So it's like it's always been to Roth IRAs where you don't have to withdraw. You don't have to make RMDs, require minimum distributions from a Roth Solo 401k or a Roth IRA. Key requirements and considerations. Again, the threshold issue, you need to be self-employed with no non-owner, non-spouse W-2 employees working for any business owned by you or a spouse, if any. Number 2, you need to have a solo 401k plan that allows for the voluntary after-tax contributions and then transfer to the Roth account. And of course, it's going to make sense. A top consideration is to look for an experienced plan provider, like my Solo 401k Financial. We provide hands-on support, not only with the mechanics of opening up the separate accounts, as well as the reporting requirements. So remember, we talked about how when you transfer the money from the after-tax account to either a Roth Solo 401k or a Roth IRA, that needs to be reported on a Form 1099-R. And we handle that as an optional free service for our customers. In other words, no additional charge. They just need to let us know about that transfer by completing a form on our website that they can do 24/7. That's how we capture the information. We add their plan to the queue to be able to issue that 1099-R. So let's go through an example just to illustrate. We've got a 40-year-old Henry consultant who earns $100,000 from a side business. Let's assume it's line 31 of Schedule C, less 1/2 of self-employment tax. They may want to skip making employee, skip making employer, just contribute 100% of their self-employment compensation dollar for dollar up to the overall limit as a voluntary after-tax contribution. So that's $70,000. Then transfer those funds over to a Roth account where it's going to have the potential for tax-free growth. Well, thank you so much for checking out today's presentation. We'll give it a moment to see if there's any more questions. If you're finding this to be helpful, please like this video. Helps us to get the word out to other self-employed individuals like yourself, other solopreneurs. Share it with others that might find it to be helpful. Please subscribe to our channels, whether on Instagram or LinkedIn or YouTube or X, as we go live every day, and then you'll get notifications of when we go live. You can check out the content that we like to bring, but also jump on, ask questions, hear what other people are asking as well. We also invite you to our community. We have the largest online community of self-directed investors. We've got over 30,000 members. We have vibrant forums. We have a library of videos and webinars. Please just email us at business@mysolo401k.net and we'll get you access. Thank you for the detail. This is exactly what I'm Thank you so much. So I'm trying to understand how money for each purpose that is earned gets from the company into the appropriate account. Okay, great. So now we're talking about how to transfer the money from a non-retirement account to your retirement account. So from a solo 401k perspective, it doesn't matter. In other words, one can transfer money from a personal account or a business account, regardless of the contribution type. You don't have to make the contribution through payroll. You don't have to make the contribution through Gusto. It can be made in one lump sum or every payroll period, as long as it's within the contribution limits and made by the contribution deadline. So for example, as long as someone signs up for a plan here in 2025, they'll preserve the ability to make all types of contributions, whether employee, employer, or voluntary after tax, by their business tax return deadline, including any time they file the extension next year. So that the solo 401k contribution deadlines, therefore, give you a lot of time relative to full-time employer plans to make those contributions. But yes, you can just transfer the money by check, electronically, etc., from any type of external account to the applicable account for which the contribution is being made. Hopefully that makes sense. So check, wire, ACH, whatever the financial institution that is providing the accounts for your solo 401k will allow is acceptable from a solo 401k perspective. Yes, it could come from your personal account. What's most important, again, is that it's within the limits made by the deadline, reported, if required to be reported, on the personal tax return or the business tax return or the W-2. All right, well, that looks like that takes us to the end of the questions for today. Thanks again for the participation. Please continue to engage. Please like, please subscribe. We do appreciate it. Take care, everyone.